Believe it or not, most people are struggling to find a correct bias. So instead of sitting there scrolling through TikTok, scrolling through YouTube for hours on end, all you need to do is sit here, watch this video, come back to it, get your notepad, get your pen and make notes, because in this video, I'm going to show you exactly how I find my daily bias from start to finish, a complete in-depth guide completely for free. I'm going to show you the basics very quickly. Then we're going to get more and more advanced, and then I will show you this, the slight complications, a few questions that you will probably have towards the end of this video. So this is a new series that I'm doing where every week I'm going to be dropping an absolute gem, near enough every week. Full depth guide, about 30 minutes, 1 hour long, showing you exactly how I use a specific tool. In this video, it is about a daily bias. How do I find my daily bias? And a daily bias is very, 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 very important, because you can have the best strategy in the world, but it means nothing if you don't know the right direction to look for trades in. So you could be using FVGs, AMD, whatever it is. You could be profitable on a 5-minute time frame with my strategy, but if you don't know how to find a correct bias and you don't know what direction to look for trades in, you're going to lose regardless. So in this video, as I said, we're going to be going through a daily bias. Like the video, comment, subscribe if you're new, all of that lovely stuff. I'm going to be dropping gems near enough every single day. I'm live every single day doing daily market outlooks on here. So much source for free. Literally streams, market outlooks, midweek psychology videos, weekend massive in-depth guides like this one. So let's get straight into it. This is going to be completely uncut, raw from start to finish. There's going to be like no cuts in this video, okay? No, nothing, okay? Simply just me, the charts, and you. Come back to this video as many times as you need to, but let's start off on the daily time frame, okay? So the first thing we need to understand is liquidity, and I'm very, very sure you understand what this is already. Liquidity is simply highs and lows, okay? So here I'm drawing an upwards move, which we're just going to move over here. I'm going to draw a down move for you as well. And we're also going to look at a consolidation, okay? Now if we just draw a consolidation, here you can see we have a nice consolidation. Okay, so this is an upwards move, very, very straightforward. A downwards move, very, very straightforward, and a consolidation, okay? Now, the thing here is that liquidity is found at every single high and low. Now, to draw liquidity out, you want to get this trend line tool. You want to get the trend line tool, okay? Draw a line, go to settings, go to text, put the $ in a couple times, go to template, save as, type liquidity, and then save. So you click save as, liquidity, whatever, and then save. Then you should get this, and now you should have a template to use whenever you're drawing liquidity out. And very, very straightforward. Liquidity is highs and lows. So if we just draw this out here, I'm going to be as quick as I can with the basics, because a lot of people know this. I'm sure the majority of the people watching this video will know what this is, and you want to just find your bias. So liquidity is highs and lows, okay? We can sit there and draw them all out, but every single high and low in this upwards move is liquidity. Every single high and low in this downwards move is liquidity, and every single high and low in this consolidation is liquidity as well. And this is referred to as equal highs and equal lows, because apart from this dip here, you can see like here we have equal highs, here we have equal lows, equal highs, equal lows. These are stronger forms of liquidity, because it's kind of like, think of it like this, like we have one liquidity zone here, and then we have another one next to it. So that's 2 liquidity zones, then 3, and it kind of just slowly starts to accumulate, hence the name of, accumulation. It gets more and more and more liquidity there. So that's what liquidity is. Very, very straightforward. It's highs and lows, okay? Now you can also refer to it, as a fair value gap as well, and you can also refer to it as a trend line. Something like this, yeah, maybe this would be a better one. Trend lines also have liquidity on them. So if we have a move down like this one, or move up, we'll do a move up, it's a bit cleaner. If we look at this move up here, there is liquidity resting behind this trend line. So when price pushes down, it will then take all of this trend line liquidity and then may even just continue up. Okay, so there's highs and lows, there's trend lines, and there's fair value gaps. Now, what is a fair value gap? Very quickly, a fair value gap is made up of 3 candles. Does not matter about the direction of the first and third candle. All that matters is the direction of the middle candle, okay? So I'm going to leave the first and third one in gray. We're going to call this green. So we have 2 types of fair value gaps, really. We have a bullish fair value gap and a bearish fair value gap. The direction of the fair value gap, whether it's bullish or bearish, is all determined by the middle candle. If the middle candle is bullish, if the middle candle is going up, we have a bullish fair value gap. And if the middle candle is going down, we have a bearish fair value gap. When we form a bearish fair value gap, there we go. When we have a bearish fair value gap, you want price to come back up into it and then continue down like this. When we have a bullish one, you want price to come down into it and continue up like this, okay? Does that make sense? So a bearish fair value gap we come up to and down from, and a bullish fair value gap we come down to and up from. Now, that's what a fair value gap is. Very straightforward. Now, to be fair, you also need to look at the wicks. If the wicks are overlapping like this, it's invalid. If there's a gap between the wicks, that is the gap. That's the fair value gap. Okay, so now we go back to the liquidity over here. Okay, the way price moves, simple. We take out liquidity. Okay, so once price has like gone past the liquidity zone, so we have this low here, right? We have this low right here. When price comes down around about here to take that low out, this then becomes invalid, because the whole idea of liquidity is that that is where pending orders and stop losses are. Okay, so write this down. I'm going to be making a few notes throughout this video. If you write this down, liquidity is where pending orders are resting. These can be found, or these can be in the form of fair value gaps, stop losses, or pending orders. Okay, so the stop losses and pending orders below liquidity zones or around liquidity zones. So there's stop losses and pending orders here. Price then comes down, activates those pending orders, hits those stop losses, therefore there is no more liquidity there. And that applies to every form. So when we take out this high, this then becomes invalid. When we take out this low, this then becomes invalid. And the stuff we leave behind still remains valid, because there's still going to be stop losses here, there's still going to be pending orders here and stuff like that. So it's still valid there, unless it's been took out. Okay, that's what you need to understand about liquidity. Now we look at fair value gaps and liquidity together. In this move down, you can see we push down, form a fair value gap, retrace back into it and continue down. Taking out liquidity, forming a fair value gap, respecting it, continuing down. Taking out liquidity, respecting it, continuing down. Okay, eventually what will happen is we'll have a change of character, and we will form a fair value gap on our way down to take liquidity, like we did right here. But instead of respecting it, we'll disrespect it, and this is called an IFVG, okay? So a fair value gap that has been disrespected is called an IFVG. And IFVG stands for inverse fair value gap, okay? Now, if you know the definition of inverse, it should make a little bit more sense to you, but if you don't, do not worry at all. Inverse fair value gap simply just means like the opposite. So it's like the opposite. So if we have a bullish fair value gap, so if we have a bullish fair value gap, right? Let's say we have a bullish fair value gap here, price comes up, forms the bullish fair value gap. If we come into it and disrespect it, it then becomes bearish. So it's like a bearish confluence then. If we have a bearish fair value gap, so price comes down, forms this bearish fair value gap, we then come back up into it, disrespect it, and it becomes bullish, and we continue up, okay? So a bullish fair value gap that has been disrespected is bearish, okay? A bearish fair value gap that has been disrespected is bullish. And what does disrespected mean? So what does disrespected mean? It simply means when a candle closes behind the fair value gap, okay? So when a candle closes behind it. So we push down here, you know, we have all these fair value gaps on the way down, we have all these liquidity zones getting taken out there before becoming invalid. Eventually we form a fair value gap, take out liquidity, reverse to the fair value gap, close above it, which is closing behind the fair value gap, making it bullish, therefore we then come up. So, and this is ERL and IRL. When price takes liquidity, it will retrace to a fair value gap. From there, it will either respect the fair value gap, which is just kind of, you know, coming into it and bouncing off of it and continuing the trend like we did over here and here, or I continue the trend. You should be writing these notes down too, by the way. Or it will disrespect it, which is a close behind it, and continue in the opposite direction. Okay, so when price takes liquidity, it will retrace to a fair value gap. From there, it will respect the fair value gap and continue the trend, or it will disrespect it and continue in the opposite direction. Okay, now let's move on to the charts to have a quick look at this. Okay, so if we just look at this move down here, okay, if we just look at this move down, you can see there is liquidity here. We'll start there. Okay, there's liquidity right here. So price takes out this liquidity, therefore making it become invalid, so we don't really need to look at it anymore. But once price takes liquidity, it retraces to a fair value gap, which it formed on the way down. Okay, 3 candles, doesn't matter about the direction of this one or this one, all that matters is that middle candle. We have a gap here, which we come back into, respect, okay, therefore we come down to the next low. Do you see how this plays out? So just focus on this specific example. So we take the low, on our way to take the low, we form a fair value gap. We take the low, we trace to the fair value gap, respect it, so we continue the trend, okay? We continue the trend. In this example, if we look over here, you can see this is a little bit messy, but there is a fair value gap right here. You can see we take out the high, leave behind a fair value gap, okay, come through, close behind it, which means we disrespect it, therefore we come down and take the low, okay? And that is it. That is simply how it works. So the concept or the principle you want to understand is that price will seek liquidity and seek to offer fair value. In other words, price goes from liquidity zones to fair value gaps, and then from fair value gaps back to liquidity. And then this leads us into the next concept, or the father concept, ERL and IRL. Okay, ERL, IRL stands for external range liquidity, internal range liquidity. Okay, now we don't really need to touch too much on this because we've just gone through it, but external range liquidity, internal range liquidity. Okay. Okay. Simple as that. What is external range? Liquidity zones, highs and lows. What is internal range? Fair value gaps. So, you know, fair value gaps are found inside the range, which means internal, inside. Highs and lows are found on the outside of the range, which is external. Every single retracement, like this is a low, this is a low, this is a low, this is a high, this is a high, this is a high, and this is a high, this is a high, this is a low, this is a low, this is a low. Got a low here as well. We have one over here, you know, over here and here and here, 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 here. Every single retracement is a high and a low. Okay, price goes from ERL to IRL, and the diagram I want you to draw out is this. Okay, we do that, and we go I. So price goes from E to I, and then back from I to E by either respecting the fair value gap, or it goes from I to E by disrespecting the fair value gap. And an example story of this would be price takes out a high, so it retraces to a fair value gap, it closes behind it, therefore it goes to the low. And then the opposite example would be price takes out a high, retraces to a fair value gap, closes in or respects it, okay, respects it, therefore continues the trend. There you go. Okay, that's it. That's all you need to understand. I've shown you what liquidity is, I've shown you what fair value gaps are, I've shown you how they work together. Make sure you got all that written down, and now simply all we simply have to do is go over a couple examples. Apply it on the daily. That's how you find your bias, okay? So, write this down. To find your bias, go to the daily and use ERL and IRL. Let's go over like 1 or 2 examples, okay? So, okay, let's stop going off into full screen. We're gonna let's look at this right here, okay? So at this point in time, where are the highs? Where are the lows? Well, there's highs up here, very straightforward. But more recently, there's a high right here. There's a low to the left-hand side over here, as well as one right over here, okay? So let's walk through this step by step. So what happened a few candles ago? So a few candles ago, price came down, taking out this low to the left-hand side over here, okay? With this candle, with this long wick candle, takes out this low to the left-hand side, leaving behind a fair value gap, yeah? Then price comes into the fair value gap, respects it, so what does it do then? Once it respects the fair value gap, what do? We continue down to take out the nearest low, continue that trend. Where's the nearest low? The nearest low would be, at that point in time, if we go back, at this point in time, the nearest low would be this wick right over here. We respect the fair value gap, we continue down to take out the low, okay? We take out this low, what do we leave behind? We leave behind a fair value gap, okay? From there, the 2 possibilities, okay? So where's the nearest low from here? Be over here, okay? So we either respect this, like this, and continue down, or we close behind it, therefore we continue up to the high. Where's the nearest high? Well, first of all, this fair value gap's near enough done its job so we can get rid of it for now. And this is the nearest high right here. Why is this the nearest high? Because we retraced. If we zoom into this, you can see it is near enough a push down, a retracement, a push down, a retracement, a push down, a retracement, okay? So if this is a retracement, this means there is a high here, which means there's liquidity resting above it. Okay, so price is going to do one of 2 things. It's going to respect this and continue down to take out this low over here, or it's going to disrespect it by closing behind it, therefore come up and take the high. Okay, it's closed behind it, so tell me what to do. It's very important you wait for the close, by the way, because sometimes you'll see a candle wick up above like this, then push all the way down anyway. You have to wait for the close. If it closes outside, it's then an IFVG. If it wicks outside, it's just a normal fair value gap, okay? So it's closed behind it, meaning we're going to reverse, meaning we're going to go to what level? This one. There we go, okay? Now, this leads me on to my next point. You don't just want to use the daily time frame, okay? Now I've shown you how it works. You don't just want to use the daily time frame. Do not use just the daily. You want to use the daily and the 4 hour. Okay? And do the same thing on there. So you literally just do the exact same thing as we just done. So you go onto the daily, you look at the liquidity, you look at the fair value gap, see what price is supposed to do next based on the daily, and that will be your bias. So, for example, right, when we disrespected this, we would expect price to continue up, therefore our bias is bullish. Okay? When price respected this one, we would expect price to continue down, so our bias is bearish. So if price had just took out a high, okay, if we go back to this day here, price took out this high, okay, meaning it is bearish. Yeah, because we took out the liquidity, we have to retrace to a fair value gap. We're bearish. Now we also go to the 4 hour and go, price has done the exact same thing here, but formed two fair value gaps, okay? So when you see two fair value gaps like this, or back-to-back fair value gaps, you want to go up a time frame to check it, but as you know, there is not a fair value gap on the daily yet, so you just use the furthest away one. So we want price to retrace back to this fair value gap. We're bearish towards this fair value gap, okay? So there's no fair value gap on the daily, but we know that we're bearish. Like, we know we're bearish here, but we don't know where we're going to be bearish to, because price has not formed a fair value gap on the way up to take out this high. So that's where the 4 hour comes in. We go to the 4 hour time frame, and there is a fair value gap, and we've got to retrace back to that on the 4 hour as well. So the 4 hours bearish because we took out a high, we got to retrace. The daily's bearish because we took out a high, we got to retrace. The only difference is on the 4 hour, we know where we're going to retrace to. On the daily, we do not. Okay, there you go. So we close below it on the 4 hour, which means what? Which means we're then bearish to come and take out this low right over here. There we go. We take out the low. Now this took a little bit more of a mess around, and the reason for this is simply just because of this low right here. Okay. Price messed around a lot here, and if we go to the daily, you can see it messed around a lot here as well. Okay, perfectly normal, but we would have assumed a bearish bias here until we took out this low. Although, if you remember what I said before about when price retraces like this, we leave behind a high and a low. Okay, so we have a high right here based on this retracement candle, high right here. Oh, excuse me. A gap here, a gap which is a little bit messy. Okay, we have to come back and fill that gap, and we also have this low over here. Okay. So what price does is it disrespects this fair value gap whilst also taking out this low, which means it's got to retrace then to the nearest fair value gap. But then we also look at the fact that there's a gap here, which makes it very, very, very messy, but it's still very easy to understand because all you have to do is just look at fair value gaps and liquidity, and you go, okay, so price is messing around here, messing around on the daily. We don't really have much going on here. We got an FVG formed here, but the reason this one didn't play out, okay, so you'd go, well, we got an FVG here, which means we need to come up and take out this high. Why didn't this play out? Because we still had to come down and take out this low, or this one over here. This had to play out still, okay? So we weren't going to continue up until we finished doing this, okay? Does that make sense? So we have the IFVG form based on this candle right here. So this candle closed below this fair value gap, therefore it's bearish. Therefore we've got to come down and take out this low over here, okay? We mess around a little tiny bit because of this gap here and just in general, because we took out this low, okay? But we form a fair value gap on the way down, retrace to it, inverse it by closing above it right here. The reason this doesn't play out, there's two reasons. The reason number one is because we still had to come out and take this low over here. Reason number two is that it doesn't align with the overall higher time frame draw on liquidity. As you can see, the higher time frame draw on liquidity at this point was bearish. We were still bearish on the daily. The daily overpowers the 4 hour. Therefore, if we have the 4 hour contradicting it, it's not really ever going to play out how you think it will. So people will see this and be bullish without looking at the daily, and this is why you got to look at both time frames, because the daily is still saying bearish. Plus, we still have to come out and take out this, okay? And as you can see, we eventually do that. So you would have been perfect to assume bearish bias here, although it did kind of mess up a little tiny bit, okay? Which is perfectly normal. But that's how you go about that. So when the daily has no fair value gap, use the 4 hour fair value gap, okay? When the 4 hour contradicts the daily, like we had there, contradicts the daily, use the daily, or rely on the daily, and wait for the 4 hour to align, okay? So when you don't see a fair value gap on the daily, use the 4 hour. When you see the 4 hours contradicting the daily, rely on the daily more, because it's a higher time frame, it's more powerful, and it will get you to where you need to be. Obviously, as you can see, perfect example here, because we had the 4 hour contradicting this, but it played out in the end simply because of the daily, okay? And the same thing happens again and again and again, okay? So on here, you know, we don't have a fair value gap, but we got to retrace. But if we use the 4 hour, you go, there's a fair value gap right here, which we retraced into, as you can see, respected, seemingly. Therefore, we've got to come down. As you can see, we come down, leave behind a massive gap, which do not be worried by. This is simply just a fair value gap, which we've got to come back into. As you can see, we disrespect it. Therefore, we got to take out the high. There you go, we take out the high. We've got to retrace. Nowhere really to retrace to. As you can see, so this was a bit messy this day. It was very messy. But there was technically a fair value gap right here, which we did respect ultimately. Therefore, we continue up to take out the new high. Then retrace. And just so on. It's literally so simple. Okay, so what I want you to write down, this is how you find your bias. Go to the daily, use ARL and IRL. Go to the 4 hour, use ARL and IRL. And then there's some like specific rules here. So if they are mixed, rely more on the daily and wait for the 4 hour to align. If there is no fair value gap to retrace to on the daily, but both time frames align, use the 4 hour. And there is a slight learning curve to this, but once you understand this, it's going to be so simple, because you'll be able to catch the retracements in every move down, the retracements in every move up, as well as the move down, as well as the move up. You'll catch every single move in the markets, okay? There are times when this may not work due to fundamentals and stuff like that, but that's the same with every single strategy. So don't expect this to work like 100% of the time. It's more about 80-90% of the time. Very easy to understand. If you have any questions on how to find your bias, drop them in the comments and I will respond to 100% of them. If you have any questions, have any suggestions for longer form videos you want to see, let me know and I will reply to every single comment. That said, subscribe, check out my daily market outlooks, check out my daily live streams where I trade and journal the trades live in front of you, and you also get access to the public journal where you see every single trade that I've taken. If you're new, subscribe, like, comment, etc. Let's get 50 likes on this video and we're going to do a giveaway. Have a good rest of your day, guys. Thanks for tuning in, and that's everything from me. Peace.